So there's a tax strategy that can let a business deduct a huge amount of money, move that money into a separate entity, invest it, and potentially build like long-term wealth outside of the normal operating business of that business owner. It's real, it's in the tax code. It's also one of the most heavily scrutinized strategies in the country right now, but all of those things can be true at the same time. And if you don't understand that, this is the kind of strategy that can look brilliant when somebody pitches it to you, maybe even in a YouTube video. And then it can end up looking catastrophic a few years later when the IRS comes knocking. I'm Adam Williams with Pennywise Tax Strategies. I've been doing this for more than 15 years. I'm admitted to US Tax Court. And today I want to show you how captive insurance companies actually work, why some of them are completely illegitimate, and why others blow up. And I'm going to show you the 5 tests I would use before I ever told a client to move forward with one. Because this is not a beginner strategy, and it's definitely not something you do just because you heard it was a good way to write off more income. So let's start with the basics. What is a captive insurance company? A captive insurance company is exactly what it sounds like. You set up your own insurance business. Your operating business pays premiums to that insurance company, and if the premiums are legitimate and the structure is set up properly, the business gets a deduction for those premiums, just like you do for your normal insurance premiums now. But because you own the insurance company, that captive holds the reserves, it invests the money, and it pays claims when covered losses happen, which actually it should in order to hold up under IRS scrutiny. That's the basic idea. So think of it kind of like a 401k on steroids. A 401k allows you to contribute $24,500 before tax and invest it for retirement. And that's nice. That's like tax strategy 101. But for some of us that are making multiple 6 figures or more, it's really a drop in the bucket. So how can we take that same idea of investing with pre-tax dollars to build real wealth? Well, when a captive is done the right way, it's not some fringe internet gimmick. Captives have been used for decades as a legitimate way to manage business risk that's too expensive, too specialized, or too inefficient to place with a traditional insurance market. In fact, like the 1,000 biggest companies in the world all have their own captive insurance companies. This is why you're always offered a warranty when you buy a piece of electronics. But this is also something that works for smaller business. So yes, this is real. But here's the part that matters. Not everything sold as a captive is real insurance. And in fact, the IRS scrutinizes these things. So you want to make sure that you're following the rules. A lot of what gets marketed under the label of captive insurance is really just a tax shelter wearing an insurance costume. And that's why the IRS keeps attacking abusive micro-captive arrangements. But the problem is not the idea of a captive by itself. The problem is when the structure has fake risk or weak pricing or little or no real claims activity. There's circular money movement, or the paperwork exists mainly to support a tax deduction instead of solving an actual business problem. Again, we're setting up a real insurance company here. So before I go any further, let me tell you who this is for. If you're a business owner and you're still missing the basics, this is not where you should start. If your bookkeeping is messy, if your entity structure isn't dialed in, if you're not using simpler and more foundational strategies well, and if you're mostly just looking for a bigger deduction, this is not your next move. But if you are looking for some of those things, we've got a great guide available. I'll put the link in the description. This is an advanced tax strategy. And in my view, you usually don't even talk seriously about this until the business has strong, consistent profit and a real uninsured or underinsured risk, not imaginary risk. Not, I want to move money around and hide out from the IRS. You need real insurable risk. For some of our law firm clients, we use this to provide excess professional liability insurance. I've seen this with car dealerships, creating a captive to offer their extended warranty programs. Even things like product liability or other insurance where you've got high deductibles or really specialized cyber exposure, employment-related risk, supply chain risk, the kind of problem where the commercial insurance market is either too expensive, too limited, or just not solving the right issue for your business. So that's the frame. If you've got the type of business that's making you profit of hundreds of thousands of dollars a year, and even into the millions, of course, and if you're spending $100,000 or $200,000 or more right now on insurance, a captive is something you definitely want to look into. So let's get into what's actually required to make these things work. There's 5 tests that I like to talk about. Test number 1, does your captive actually behave like insurance? And it's not just with captives where people get in trouble with this. They forget form over substance and realize this actually has to be an insurance company. So this is the first question I want to answer. If you say this is an insurance company, does it actually behave like one? Because real insurance companies take in premiums and pay claims, and whatever's left over, they get to invest, and that money grows over time. And I know this sounds obvious, but this is where a lot of bad structures fall apart. The pitch often sounds like this. You move money out of your business, you deduct the premium, so tax-free. Claims rarely happen, and the money just accumulates, and eventually you'll benefit from it, or maybe your children get to inherit the shares of your insurance company and have all this wealth. And that pitch sounds really attractive. In fact, I'm a huge fan of captive insurance companies. But it's also why the IRS pays so much attention to these arrangements, because a lot of times they're not done properly. So if the structure looks less like an insurance company and more like a place where money goes in and almost never comes out, that's a problem. So the good news is these captive insurance companies get set up as a C corporation, and like any successful good C corporation, they're going to pay dividends to the shareholders. So you are able to pull some money out of this, but there's limitations to it. So to be clear, I'm not saying every captive has to pay huge claims every single year. That's not the point. The point is whether over time the captive shows real insurance economics, and you need experts to give you opinions on this. Are claims being filed and paid in a way that makes sense for the risks being insured? Or is this really functioning like a tax-favored bucket with the word insurance stamped on the side? Because if it's the second one, you're not looking at healthy insurance behavior. You're looking at the kind of structure the government has been targeting for years. So that's test number 1. Does this thing actually behave like insurance? Test number 2, is there real risk distribution? The second question is whether there's enough real risk inside the captive for it to function like an actual insurance company. This has been one of the core issues in captive cases for years. It's not enough to just say risk was shifted from your operating company to the insurance company. The law also cares about whether risk was distributed. So in plain English, the captive can't simply insure a tiny pocket of closely related risk and expect that alone to carry the day. So this is where people start reaching for workarounds and making up their own rules. You'll see reinsurance pools. You'll see pooled structures. You'll see elaborate diagrams that are supposed to make the structure look broader and more diversified. Now, some of these arrangements can be legitimate, but some of them are really just window dressing. If the structure creates the appearance of risk distribution without the substance of it, that's not good enough. And they're going to use a common sense approach to this, or a reasonable person approach to this, to decide whether it actually makes sense or not. So the question isn't whether somebody can show you a fancy chart. The question is whether the captive can clearly demonstrate real risk distribution with real insurance economics behind it. This reminds me of math classes in college. We were taking calculus, and I remember the math instructor, professor, whatever he was, said there's 2 things you can do with a math degree. You can either become a math teacher or you can become an insurance actuary. So don't worry, there's like nerds that look at this stuff all day long, and I'm so grateful for that. So we're not just talking about paperwork here. We're not just talking about terminology or like a memo that gets thrown into the file. We're talking real risk distribution. And if that answer gets fuzzy, I would slow down immediately. Because when a structure only works if nobody asks too many questions, that's usually not a strong structure. Test number 3. Were the premiums priced like real insurance? This is one of the clearest ways to tell whether the strategy was built from the business problem or built for the tax deduction. Bad captives are often priced backwards. The owner says, I want to deduct a certain amount of money. And somehow, like magic, the premium lands right on that number. That's not how real insurance pricing works. You don't get to name your own price. Real insurance pricing starts with the risk. What is being insured? How likely is the loss? How severe could the loss be? What does the commercial market with third-party insurance companies charge for similar coverage? What does an actuary include? Here we are with the math majors again. This is how premiums are supposed to be determined. You don't start with, how much do I want to deduct this year, and then work backwards until the premium gets there. This becomes a huge problem if the IRS ever looks at your structure. So if I'm looking at a captive, I want to see real actuarial work. I want to know how the risks were identified. I want to understand why the premium makes economic sense. And I want that explanation to sound like insurance, not marketing, not tax sales language, insurance. So if you're working with a captive insurance company that won't show you the actuarial basis, or if the report reads more like a brochure than a serious risk analysis, that should tell you something. Because bad premium pricing is one of the fastest ways for a captive to reveal what it really is. Not insurance, deduction shopping. So test number 4, where does the money go? This one's huge. Where does the money actually go after the premium is paid? So you write the check from your operating business that generates income for you, and what happens with that check? In a real captive, the money goes into the captive. It stays there as insurance capital and as investment reserves, which are a legal requirement. Claims get paid when claims arise. You'd be amazed at how many people set up these structures and don't actually pay the claims in a timely manner. Now, if you've insured a real risk and if your premiums accumulate over time, then yes, you will have a surplus, and that needs to be handled appropriately. But in the meantime, the captive functions like an insurance company. In a fake captive, the money has this funny way of wandering back where the owner wants it to, usually back in their bank account. Maybe through loans or like related party deals, or maybe through guarantees, or maybe through some clever but not so smart structure that gives the owner practical access to the cash again. This is a serious problem, because once the money starts circling back, the insurance story starts falling apart. If the economic reality is that the business never really gave up control of the funds, or the business owner never really gave up control of the funds, then the IRS is going to have a really strong argument that this was never what it claimed to be. And this is one of the easiest common sense tests in the whole conversation. And there's no reason to get cute or creative here. There's laws and guidelines on this that if you're working with a trusted advisor, they can help you make this work within those guidelines. So if somebody's pitching you a captive and also spending a lot of time explaining how you can get the money back out, that shouldn't be comforting. That should be a warning sign. A legitimate captive is not supposed to feel like a boomerang. I've never been able to get a boomerang to work. The money is supposed to leave the operating business and go into an insurance company that actually has to behave like an insurance company. It invests the premiums, it pays out the claims, and eventually accumulates a surplus, which it can pay out as reasonable dividends. So that's the 4th test. Does the premium stay in the captive to serve an insurance function, or does it make a suspiciously convenient round trip? If it comes back too cleanly, too quickly, too cleverly, I would be very concerned. So test number 5 for your captive insurance company. Are claims actually being handled in real time? This is the least sexy part of the conversation, which is probably why so many people ignore it. But it matters. Are real claims being filed, reviewed, documented, reserved, and paid in the ordinary course? Now, here's the good news. You've set up this captive insurance company. You've established this separate C corporation. You are the owner of that C corporation. But that company hires vendors and experts and professionals to handle all of this work for you. And it has to be done in a reasonable amount of time, not after the IRS sends a letter. We've seen a lot of companies get in trouble for this. It shouldn't happen after somebody realizes the file looks a little thin, and not after a lawyer gets brought in to clean things up. I mean, claims get paid in real time as part of the normal life of the captive. A legitimate captive should have claims procedures. There should be files. There should be documentation. There should be evidence that something happened and the captive responded the way an insurance company is supposed to respond. But again, there's experts to help guide you through this. When you don't see that, it becomes much harder to defend the idea that the captive is really in the insurance business. So again, I'm not saying every captive has to be paying enormous claims every year. That's not the point. The point is whether the arrangement looks alive as an insurance company, or whether it just sits there collecting premiums, building reserves with little real-world claims activity. If it looks more like a vault than an insurer, that's not a good sign. So what does a legitimate captive actually look like? This is where people get confused. They hear all the enforcement stories and assume the strategy itself must be illegitimate. The IRS puts it on its dirty dozen list or its listed transactions list. That doesn't make the strategy inherently risky. A real captive can make sense with the right set of facts. Let's take a law firm as an example. They may have exposure above what a standard carrier will reasonably cover. A car dealership or dealership group may have real extended warranty exposure. A construction company may have large deductible layers or specific coverage gaps. Or any other business may have specialized risks where the commercial insurance market is expensive or narrow or inefficient. Again, we're talking about insuring real risks. Those are the kinds of real-world business problems captives were built to address. And yes, in those situations, the tax and wealth building upside may also be real. A captive can accumulate retained earnings. It can hold investments. It can potentially become part of a broader long-term planning strategy or estate plan. But this is the order I want you to remember. Insurance first, tax treatment second, long-term wealth building third. If somebody's pitching you the wealth transfer angle or the deduction angle before they have clearly shown you the insurance need, they're leading with the wrong thing. And that usually tells you a lot. So let's talk about the economics. This is another reason this strategy is not for everyone. Captives are expensive to set up. They're expensive to maintain, and they require real administration. This is not a casual strategy. This is not a one-year experiment. And this is definitely not something you do with bargain bin advisors. You are creating and operating an insurance company. That means feasibility work, legal work, actuarial work, compliance, management, capital, ongoing administration. So for many businesses, even if a captive is theoretically possible, it still may not be economically smart. And that's why I care so much about fit. A strategy can be legal in theory and still be completely wrong for your business once we look at the amount of money required and the amount of your time that needs to be invested in it. And this is a really important distinction. The question is not, can this be done? The better question is, does this make sense here for me? So who should do this and who shouldn't? Here's the practical filter I would use. A captive insurance company may be worth exploring if your business has strong recurring profit, real uninsured or underinsured risk, a genuine reason to create an insurance company, and a willingness to run it properly, and advisors who are conservative enough to document and defend the structure. This is probably not for you if you're mostly looking for a deduction. It's probably not for you if the economics are too small to justify the cost and complexity. If you're not making several $100,000s a year, this isn't for you. And it's definitely not for you if the risks are thin, artificial, or hard to explain. And it's absolutely not for you if the advisor keeps emphasizing how fast and easily you can get your money back out. And one more thing. If nobody involved can clearly answer the 5 tests we just talked through, that alone should make you nervous. Not necessarily about the captive idea generally, but about the specific advisor or professionals that you're working with. That's the real divide in this area. Not captive versus no captive, it's real captive versus fake captive. And the IRS is not confused about that difference. So a legitimate captive insurance company can be a powerful strategy. It can allow you to take hundreds of thousands of dollars or more out of your business every single year without paying tax on that money, investing it and building wealth over the long term, and stand up against IRS scrutiny if you do it properly. But it's powerful in the same way a chainsaw is powerful. In the right hands, for the right job, with the right safeguards, it can do exactly what it's supposed to do. In the wrong hands, it can make a terrible mess. So before you move forward with anything in this area, run those 5 tests. Does it actually behave like insurance? Is the risk distribution real? Are the premiums priced like real insurance? Does the money stay where insurance money is supposed to stay? And are claims actually being handled and paid in real time? If those answers are clean, documented, and economically sensible, then you may be looking at a legitimate strategy. If those answers get slippery even once, yeah, you're probably buying some tax savings and even bigger headaches down the road. You're buying a future argument with the IRS, and those get really expensive. If you want help thinking through whether a strategy like this even belongs in the conversation for your business, that's exactly the kind of thing we help clients evaluate. And if you're interested in more content like this, like and subscribe. Because the biggest tax mistakes usually don't happen when people know too little. They happen when people know just enough to be dangerous.